It was a tough journey going from an intern to a senior professional. Now, to protect my savings against high inflation and grow my wealth, I invest in bonds with INR Bonds. Download the INR Bonds app to save better.
Hello everyone, welcome to Search for Yields, fortnightly newsletter from INR Bonds. I am Nikhil. In today's topic, I'll be discussing with you about the latest RBI notification on the increase in risk weights for NBFCs and scheduled commercial banks. Before we go to the topic, I would just want to give you a brief idea on why the why RBI came up with this kind of notification all of a sudden and what it's trying to imply. So, from the latest policy meeting that happened in the last month, where RBI said that there is a good amount of consumer lending happening and very aggressively from the fintech players and NBFCs. So this can lead to potential a small kind of an issue in the market, where the total currently it's close to 5% of total lending to this kind of a segment of consumer lending. Typically, in this sector or the segment where the borrowers take the money at a rate of 20% plus personal loans, or be it any kind of credit cards. Credit cards typically do it 3% per month. That means close to 30% plus kind of a annual rate of return. So RBI wants to want to be a little cautious on this and wants to increase more scrutiny in this segment. And on the other side, if you see the job markets in India, the IT companies have stopped the hiring, and being the big guys or the small guys, the hiring is not really as going at a pace which we have seen in the last 2 years. So this is also a concern, and globally, the big tech guys, be it the Amazon, or be it Microsoft, or be it Google, or they're also shrinking their working sizes. So this can have an impact on the unsecured lending market, where they have to pay their EMIs or monthly interest payments or principal payments. So it will have an impact. So on basis of that, RBI has come up with these guidelines. So basically, in this notification, it simply says it asks the lenders to increase the risk weights, the exposure to the consumer credit lending, and excluding the housing finance companies, gold finance, education loans, and microfinance and vehicle loans. Apart from that, any other loan which comes under the category of consumer credit unsecured lending, they asked NBFCs and scheduled commercial banks to increase the weightage from 100% to 125%. And for a credit card receivables of a scheduled commercial bank or a NBFC, they asked the risk weights to 125% to 150% for a credit card receivable of SCB, that is scheduled commercial bank, and for 100% to 125% for a NBFC. And for a bank which is lending to NBFC, where they have external credit activities, okay, apart from the core investments, it also asked RBI asked them to increase the risk weight by 25 basis points from the current levels. So how this is going to impact the whole sector is where especially the lenders with the very neck to neck the CET ratios or the capital adequacy ratios, they're going to have a tough time, as in the RBI, the minimum rate of the capital adequacy is 15%. So the difference between the CET1 ratio and a capital adequacy ratio is very simple. The CET1 ratio is it takes mainly account of the equity and the last year's the earnings which has been reinvested in the company. That is a CET1. It doesn't take care of the tier 2, that is unsecured lending. The capital adequacy ratio takes both the tier 1 and the tier 2. So that's why the tier 1 makes a lot of sense here. So let's focus on the tier 1, the ratio. In this tier 1 ratio, when your risk weights, the denominator of the ratio, that gets increased, obviously the total that figure, the percentage figure will be decreased. So let's say a NBFC currently having a capped CET of 16% at 100% risk weight, and when it is increased to 125%, it will fall close to 15%. So 15% is the lower benchmark that RBI has set for all these lending guys to maintain at minimum capital at any point of time. So with this, if you see this chart, where it is so the sources are Spark Capital we have taken from that note, where if you have seen RBL Bank, let's say the old the CET is 14.6%, and with the new CET, it's it'll come to 13.7%. So such banks, scheduled commercial banks, have to come out and to raise funds in the from the market. So when currently, in which ways the market liquidity is pretty much dry. So when there is a sudden supply of bonds, and with the liquidity dried up, there is a sudden sharp. There will be sudden sharp in rise in yields. This kind of situation we have witnessed in this March, in March 2023, where the AAA bonds have been traded above 820, 830 levels, kind of a level, and we have seen a complete change in levels, and even the GSEC itself being traded close to 7.5% levels in this March. So if you take the NBFCs, the SBI card, that is a credit card company, with a so that has taken the highest hit, and from 21% kind of CET1 levels to close to 16.5% levels. So almost a change of 4%. As the credit card companies have taken the risk weights have increased from 125 to 150%. So it has taken the highest hit. So as of now, maybe they wouldn't require a lot of capital, but eventually, without a capital, the bank or a credit card company cannot run the business. So they'll have to come to the market and they issue bonds, or they have to go to any other lenders in the market to issue fresh capital. The best part is the housing finance companies are at a much comfortable space, and the gold finance companies as well, where they don't have to worry about these regulations, and as these regulations do not apply to them. And even for the NBFCs, of the microfinancing companies or MSME companies, let's say the 5-star business finance, they have a capital adequacy of more than 50%. They're very well capitalized. So such companies, even if they fall into this category, they really don't have to worry about the new regulations, as they are well capitalized. So these regulations have impacted the equity share prices after the announcement. We have seen Nifty Bank Index opened 1% lower, very well traded index after the Nifty, as more option players are very active in this segment. We have seen the Nifty index down by 1%, and a few lenders also seen the SBI credit card company have seen share price fall by close to 6% on Friday. So this will have an likewise impact in the bond market as well. And when they come with the issuances in the public or private placement, with the highest, more supply will be there in the market, leading to the secondary market yields rising up, and as well as the primary yields at higher levels. Thank you for listening in. And if you want to check out the best investments in the secondary market, the best place for you to go is QuickInvest by INR Bonds. It's a retail platform for investors. The app is available on both App Store and Play Store, where you can download the app and access our curated list of bonds and experience the smoothest process of investment in bond markets. If you are a financial advisor, check out our partner portal, and you can place bids on offers on behalf of your clients and access our curated list of bonds, data, research notes to expand your assets under advisory, and also participate in the primary debt issuances on behalf of your clients. Thank you for listening in. Do subscribe to our YouTube channel if you're not done so already. Thank you.
Attention financial advisors. Want to attract new business and customers? Offering a new asset class is the key. With debt mutual funds and MLDs losing their tax advantages, your clients need to diversify fast. Look no further than corporate bonds, the perfect solution for safety and good returns. Partner with INR Bonds for expert guidance and valuable resources to get started. Access a wide range of bonds on our portal and manage your client investments with ease. Visit partners.inrbonds.com today and unlock new business potential.